Welcome to this explainer. Today, we're diving into a fascinating data-driven stress test of Bitcoin's actual utility based on some really sharp recent financial analysis. Look, there are a lot of narratives floating around in the crypto space, right? But today, we're setting aside the marketing, we're setting aside the memes. Instead, we're taking a completely curious, objective look strictly at the underlying numbers and the core economic realities that actually drive this ecosystem.
Here is our roadmap for today. Number 1, the crypto Jenga tower. Number 2, 3 tests of money. Number 3, the El Salvador experiment. And number 4, the greater fool theory. Let's jump right in.
Section 1. The crypto Jenga tower, Bitcoin's foundational role.
Now, what's really interesting here is how the source conceptualizes Bitcoin. They describe it as the bottom block in a very tall, very unstable game of Jenga. We all know the industry relies heavily on this rotating cast of narratives, that it's digital gold or the future of money or a hedge against inflation. But when we test these stories against actual hard data, it seriously questions the structural integrity of this entire tower. And understanding this foundation is absolutely crucial because it's the only way to accurately evaluate the massive trillion-dollar market built directly on top of it.
To really stress test its true value, the analysis takes us all the way back to 2008, using the original benchmark, Satoshi Nakamoto's white paper goal. The stated design was meant to be a peer-to-peer electronic cash system, period. So, by anchoring our analysis back to this defining document, we can objectively measure its performance against its actual intended purpose, effectively cutting through all the noise of modern speculation. That brings us to Section 2, 3 tests of money, the economic benchmarks. The source evaluates Bitcoin using the 3 classic economic pillars. To be considered functioning money, an asset must be a medium of exchange, a reliable store of value, and a standard unit of account. Now, these aren't just dry academic terms, okay? These are the absolute non-negotiable requirements for any currency to actually circulate, facilitate trade, and sustain a modern economy. Without them, an economic system fundamentally breaks down. So let's look at the data and see exactly how it measures up. First up, let's look at it as a medium of exchange. The network processes roughly 500,000 transactions a day. But compare that to Visa, which clears that exact same volume in under 8 seconds. Seriously, 8 seconds. A true medium of exchange needs to be fast, it needs to be efficient, and it has to handle global commerce seamlessly. The data starkly contrasts the network's processing capacity with the daily, high-speed reality of global transactions. And the inefficiency is highlighted even further by a staggering environmental metric. The energy required for just a single transaction equals what an average American household uses in 43 days. That's over a month of electricity for one transfer. When you combine the slow transaction speeds with this massive energy footprint, which is roughly equivalent to 1.5 million Visa transactions, it provides a very clear data point on why widespread adoption at the retail checkout counter has faced such massive structural friction. Moving to the second test, the source explains that an asset just cannot be a reliable store of value if it acts as a volatile, speculative investment. A true store of value preserves your purchasing power over time, but if your life savings or a company's corporate treasury can swing 20% in a matter of weeks, that kind of volatility introduces a level of financial unpredictability that is incredibly difficult for everyday households or major global supply chains to manage effectively. Furthermore, we have to talk about extreme ownership concentration, which leaves the asset incredibly vulnerable. With 95% of the wealth held by just the top 5% of addresses, relatively small groups of large holders can trigger massive price movements. The analysis highlights that this level of centralization runs completely counter to the fundamental requirement for broad, stable wealth preservation. It heavily undermines the whole narrative of decentralization. Finally, the unit of account test. The analysis notes a fundamental failure here because Bitcoin isn't actually being used to price goods and services natively. Think about it. Even businesses that eagerly accept crypto don't price a cup of coffee in fractions of a coin. They price it in dollars, and then the conversion happens at the exact split second of the transaction. It's not a true unit of account. It serves purely as a temporary pass-through vehicle. Let's move to Section 3, the El Salvador experiment, a real-world case study. To prove these economic theories aren't just speculation, the source points us to a massive, countrywide field test. In 2021, El Salvador provided the ultimate stress test by legally adopting the currency and heavily incentivizing its citizens to use it. We're talking about a government that built the digital infrastructure, legally mandated its acceptance across businesses, and literally handed out free money to try and jumpstart an entirely new monetary system.
But check out these IMF results for remittances. Now, remember, remittances were marketed as the magical use case for this technology. Yet 98% of people completely bypass the crypto network when given the choice, sticking directly with the traditional financial system. This gives us crucial insight into real-world utility. Even with heavy government promotion and established infrastructure, user preference leaned overwhelmingly toward traditional established methods. The domestic data is equally compelling. According to the National Bureau of Economic Research, 60% of users cashed the initial $30 government incentive and just bounced. Let that sink in. It demonstrates that even with a frictionless, state-sponsored rollout, public adoption stalls when the practical utility just isn't there for the end user. This matters significantly when projecting future global adoption models, showing that legislative mandates alone simply aren't enough to change entrenched consumer financial habits. Which brings us to our final section, number 4, the greater fool theory, explaining the valuation. Since the data objectively shows it fails the functional tests of money, we arrive at the core economic theory the source uses to explain its current valuation, the greater fool theory. It's a classic financial concept suggesting that the price relies entirely on a cycle of hope and future buyers rather than intrinsic worth. Essentially, the asset is purchased largely on the belief that someone else down the line, a greater fool, will eventually pay an even higher premium for it. And this perfectly explains why those shifting narratives we mentioned at the very start are constantly deployed. Unlike a stock that gives you a share of a company's profits or a commodity that you can use to manufacture physical goods, this asset generates no cash flows. It produces no tangible goods. Therefore, it relies entirely on the continuous influx of new capital. The narratives are the critical mechanism required to attract that capital, build the hype, and keep the entire system moving forward quarter after quarter.
So we are left to ponder this chilling final thought from the source's analysis. It questions the ultimate sustainability of this entire financial ecosystem once the influx of new buyers eventually stops. Because the uncomfortable reality of the greater fool theory is that the music always stops eventually. So what actually happens to the base of that Jenga tower when there is simply no one left to buy in?